Hi there. My name is Graham Milligan. I'm a financial advisor on the Limestone team at Asante. We service our clients throughout Ontario, but primarily in Kingston and Brockville area. I'm going to take you through a quick presentation on term insurance, and then we're going to discuss the differences between term insurance and mortgage insurance and highlight a few key issues with a mortgage insurance product. So I just want to start off with a few key pieces of terminology. The life insured. The life insured is the person covered by the insurance policy. The owner. This is the person that can make the decisions about the policy. The beneficiary. The beneficiary is the person who receives the proceed when the insured passes away. So, if you're buying a life insurance contract, typically you would be the life insured, the owner, and the beneficiary would be your spouse, someone who's going to receive the proceeds. So what is term insurance? Term life insurance is a type of life insurance that guarantees premiums to stay the same for a given number of years. Terms can be any number of years, however, the most common are term 10, 20, and 30. So essentially what you're doing here is you're buying a block of time where the premiums will remain the same. After the term is up, premiums will go through an automatic renewal process, which is usually 3 to 5 times more expensive. Essentially, the insurance company is trying to get you to rewrite for new insurance at this time because they're making the insurance so unaffordable that it's much more attractive to go and buy a new life insurance policy. As long as you're healthy, that's what we would recommend. Now, if this is a policy that you're looking to have in lieu of your mortgage insurance, then we would suggest whatever the remaining amortization is on your mortgage, that should be the term length of your insurance. So if you have 10 years left on your amortization, then you should buy a term 10, 20, and 30, and so on. One key thing I want to highlight today is that all life insurance provides a tax-free lump sum benefit at death to your beneficiary. So if you buy a $500,000 term policy, but when you die, $500,000 will be deposited one time into your beneficiary's bank account. So why buy term insurance? Term insurance is cost-effective protection. Usually, if you can afford to purchase a home, you can afford to insure it. I'll get into pricing a little bit later on in the video. Level premiums for the term. So this is what I spoke about earlier, where premiums stay the same for the given number of years that you paid for. Covering mortgage debts, covering other specific debts, covering years until children have graduated from college through income replacement, covering tuition costs for post-secondary education, and the list goes on for reasons why you'd want to get life insurance. Another big factor and differentiator between term insurance and mortgage insurance is that with term insurance, you have the ability to convert to a permanent life insurance product. Now, I'm not going to get into permanent life insurance right now because that could be a whole nother video on its own. But essentially, there are a lot of great things that you can accomplish from tax planning to leaving a charity some money through permanent insurance. So we can discuss that at a different time. In terms of premiums, just to give you a little bit of an idea how expensive term insurance is. So this is T20 premiums, smoker status, male, a 30-year-old at 500,000 is 3150. Okay. Now, if you're wanting to include your mortgage, income replacement, tuition, all of these things that we typically recommend, you're typically probably in this $1 million or more of insurance. So you can see that's about $56.70 for a 30-year-old. As you go on and you age, you can see that premiums get quite a bit more expensive, so all the way up to $129 a month for 500,000 at 50-year-old, and so on. So hopefully that gave you a little more information on what term insurance is and how that product works. There's one more thing I'd like to focus on with term insurance, and that is underwriting. So underwriting is essentially the process in which you go through to be eligible for the insurance. So typically, you would sit down with your advisor and you'd fill out the health questionnaire at the time of application. And depending on how much premiums or how much insurance you're buying, how old you are, and if the questionnaire determines if you're healthy or not, you may have to provide more medical evidence. That could include vitals, urine analysis, and even blood profile. But the big thing is here that the insurance company is doing their due diligence to figure out if you're eligible for the insurance ahead of time. Now, let's get into mortgage insurance. So what is mortgage insurance? Mortgage insurance is a product where typically facilitated through your mortgage provider, so like a bank, for example, they would offer you life insurance on the value of your mortgage amount. So if your mortgage amount is $500,000, and you add this life insurance, that would essentially, if you pass away, that would essentially deplete your mortgage and the bank would be paid off and there'd be no more payments to be made. So that is a good product in essence. And I'm not trying to hate on mortgage products. There's a lot of good products out there, and it's still a very important thing that needs to be addressed. However, the one big problem with mortgage products are that they usually do their underwriting at time of claim, and it's called post claim underwriting. So essentially what that means is you pass away and then the insurance company determines whether you were eligible for the benefits or not. So what happens is you've been paying for these benefits for however long, like could be up to 25 years. And as soon as you pass away, the life insurance company could say, oh, you weren't actually eligible for those benefits and not pay out. If you've made it this far in the video, thank you so much for sticking around and hearing me out on this. If you'd like to see more information about post-claim underwriting, I'm going to leave a video that CBC did a long time ago that highlights all the issues that I spoke about in greater detail with mortgage insurance. If you'd like me to take a look at your existing contract to see if these post-claim underwriting rules apply to you, then I would be happy to. Please reach out. I'm going to leave all my contact information below and be happy to have that discussion with you. Thank you so much and have a great rest of your day.